Thanks for listening to the Adulting is Easy podcast. Please take a second and hit follow wherever you can if you can safely do so. This is Lauren, and before we jump in, per usual, I have a bit of business to attend to. A core group of us, kind of Twitter friends, Stephen Wealthy, I am Coach Clint, and the Frugal Gay are doing Twitter Spaces live on Wednesdays at 9:30 Eastern Time. And we invite guests sometimes, and there's also oftentimes for you to ask questions or maybe even speak yourself. We've covered getting started in real estate investing, getting started in crypto mining, and real estate horror stories, maybe another one or two by the time you hear this. If you're listening, on or around late 2021, keep an eye out for more of those, and you can hear the ones you've missed on this feed. All right, now back to our regularly scheduled programming, if you will. I'm joined today by Ross, a 23-year-old long-term investor. His main investing strategy involves index funds and dividend growth stocks. He started his Twitter account, which is Dividend or Hero Dividend, right, to learn more about investing and to help others along the way. Thanks for joining me, Ross.
Yeah, thanks for having me.
So our goal for today is to make adulting a bit easier for the listeners by discussing a personal finance topic, since managing money is a big part of adulting. So Ross, today you and I are going to talk about dividends. So what exactly are dividends?
Yeah, that's a great question. So dividends, as a broad definition, are cash payouts that companies distribute to shareholders. Most companies pay them out quarterly, so once every 3 months, but there are some companies that pay monthly. So as a general sum, they are cash payments paid to shareholders by usually mature companies.
I learned something already. I didn't know there were monthly dividends.
Yeah, it's there's one company that their nickname is actually the monthly dividend company. Like when you go to the website, they're the company's Realty Income stock ticker. The stock ticker is just an O, but they're known for paying monthly dividends. And you have to have a certain business model and structure, and your business has to be generating enough cash flow in order to sustain paying monthly dividends. So it's not super common, but there are monthly dividend paying companies out there. So pretty neat fact there.
Why would companies pay out their cash?
Right. So at the end of, so I'm going to mostly stick with quarterly. It's the most common example. But every quarter, a company reports earnings, and they do an analysis of how much cash they have on hand, retained earnings, net income, things like that. So hopefully the company has made a profit, which is why you normally find dividends in companies that have been around a long time, in mature industries, things like that, because these are companies that are turning large profits and have a lot of cash flow. So they have two options with their cash. They can either keep it for themselves and grow the business, or they can pay it out to shareholders. So you think about a company like Tesla or Amazon, and you name it. There's so many companies that don't pay dividends. Well, they're keeping their cash and using it to grow the business internally, whether that be like mergers and acquisitions. There's all kinds of ways they can use their cash internally. But you think about companies that pay dividends, like Johnson & Johnson, Procter & Gamble, Coca-Cola, companies that have been around forever. They aren't as growth oriented. They have built very strong companies that have been around for ages and are going to continue to be around for ages. And their goal is not to grow this company and scale it even bigger. Like they found a system that works. They're selling shampoo, they're selling medicine, they're selling things people need. And so paying out a dividend incentivizes people to, one, buy stock in their company of, okay, this is a good stock to own. And I can build some cash flows through it. So companies pay out dividends in order to incentivize shareholders to buy stock. Um, and then there are tax reasons of why they would not want to hold a bunch of cash and distribute it. So they, they'll keep some for themselves. A pretty healthy ratio is in between 40% and 60% is usually what I look for. It's called the dividend payout ratio. It's how much of their retained earnings they pay out in the form of dividends. So I normally look for companies that are paying out between 40 and 60% of their earnings in the form of dividends, and then keeping the rest for themselves in order to sustain a healthy business.
Right. Because if you were seeing a dividend payout ratio of like 90%, I don't even know if that exists or not. But if it did, you'd be like, well, why do you have no plans for your business for the future? How long are you going to be around?
Right, exactly. So there is one wrinkle to that. It's funny that you mentioned 90%. There are stocks called REITs, so real estate investment trusts. They have a structure where they are obligated to pay out 90% of their dividends or their net income in the form of dividends. So REITs for short, you will see very high dividend payout ratios, and there's other metrics that you can look at in order to determine the health of the dividend. But yes, as a whole, stocks that are not real estate, that's like the one of the quickest metrics I look at is the dividend payout ratio. So dividends really boil down to how the company uses and spends their extra cash at the end of each quarter, whether they pay it out to shareholders or they keep it internally for themselves.
Yeah, REITs, if they don't pay out 90%, they basically have to pay extra taxes, right?
Right, exactly. So there's corporate tax reasons that are folded into that from the company side. Some of those I'm sort of familiar with, some of those I'm not sort of familiar with. But yeah, it boils down to tax reasons and other corporate reasons. So, that's why you see companies that pay dividends, most of them have a long track record of doing so, and that's the direction they're taking their business. Usually you look for companies that you've been paying out dividends for a long period of time. It's not very common a company will like pay a dividend for 2 quarters and then stop and then continue to pay and then stop and then continue to pay. It's just kind of their business structure, and so that's their that's how they're gonna operate their company and their stock and things like that.
Mm-hmm. I want to get back to the track record in a second, but before that, how did you become interested in stocks at all?
Yeah, great question. I get asked this a lot. I'm 23, and I invest a lot of my money, and it definitely is always on my mind. And most people my age, that's not the case. I wish there were more people that it was the case, but
Yeah.
that's why I have an account and preaching the message. But I invested money that I got from my high school graduation. My dad is big into investing, and I took a personal finance class in high school. We did like a stock simulation game to like Market Watch, I think, and you get like a fake $100,000, and it was like a group project. And our teacher just wanted us to learn about the markets and just some basic financial concepts. And I wish it was something that every school had to take. Even if high schoolers learned one thing from that, I think it'd be beneficial. But I took a personal finance class. I'm sure my parents told me to take it, but I'm glad they did. And so I got money from my high school graduation, and I decided to invest it. And I did it with my dad, and he helped me set it up and put it in just like a broad-based index fund. And then I kind of forgot about it for about 2 years. Went off to college, and just I wasn't even a priority of mine. Just didn't even really, kind of just forgot I had it. And I always tell people that's probably the best thing that ever happened to me, because I think I started, I was a business major at college, and so as my classes got more advanced and started keeping up with news articles and headlines, and had professors talking about the market, I was like, oh yeah, like I've got stuff invested. Like how do I check that? How do I I logged in, and started looking at it and started reading, and kind of once you start, it's really hard to stop. And so my just really piqued my interest, so my knowledge base and my motivation grew from there. And so it was really cool just to see, like, looking back, like, oh my gosh, look at how much the market has fluctuated. And if I had kept up with it this whole time, I don't know what would have happened, but I literally forgot about my investments. So I always tell people, like, I wish I could do that today. Like, I wish I could somehow, like, forget the stock market, like, just let money auto invest and just check it in 20 years, 30 years, whatever time frame. So that really is the goal, is let your money work over many years. So it was a good lesson that I learned early on. So I try to take that long-term approach as an investor now. So that's kind of
Yeah,
how I got started.
thinking long term at 23 is probably pretty rare. So do you think there's a chance if you would have remembered it that whole time that you would have freaked out over some kind of news and maybe sold it or got out?
Yeah, no doubt. Because after that, I'd put money in, and then there'd be some headline, and stock would sell off like 2%. And there's been plenty of stocks I've owned and I've sold, and just early on, it wasn't didn't feel like a ton of money at the time, but it felt like stupid mistakes looking back, of like, oh, if I had held X, Y, and Z
Mm-hmm.
stock, like, I'd have nothing crazy. Like, I'm not out here taking crazy bets, but like, I definitely would have had some pretty nice returns if I had just ignored the noise and focused on the long term. Um, I think a lot of people still struggle with that. I mean, I don't think anybody's perfect, but I've gotten a lot better in watching, some of my stock sell off and be a little bit more volatile. Um, so definitely lessons learned along the way. And, I think every investor goes through that, of learning a few lessons the hard way.
Right. I think when I first started investing, I mean, I bought my first house at 23, but like I didn't really, I think I did my 401k maybe at 24. And
Okay.
I would check it like a little too regularly at first. And then I was like, well, it's not doing anything. I'm not even going to look at it. Right. And that was
Right.
like 2014,
Right.
15. So then it kind of became a little, I kept contributing. Then it became a little more fun to look at it. But yeah, lately, like my husband will text me, he's like, the market's up, the market's up, the market's up. And I'm like, first of all, why is the market continually up right now? I have no idea. Well, I guess we had a red day recently, but I'm like, I don't need to know. I don't need to know. And I
Right.
wish I didn't sometimes. So back to your personal finance class from high school. How'd you do in your stock simulation?
Oh, that's an excellent question. I don't think I've gotten that one before. I remember not doing great. I think my group, we took some advice from my dad, and we did pretty well in the beginning. And then it was kind of one of those things where, like, we're having fun with it, and I think we got a little too confident, so we started taking like some bigger bets, and then we started losing some money. And then once we were like behind, we were like, yeah, we can't catch up. So, like, kind of doing some ridiculous things. I don't remember that all too vividly, and some of that might be getting mixed in. When I went to college, I went to Clemson, and we were in a it was called Wall Street South Investment Club, and it was basically that same thing. But it was through Clemson, and so we paid our dues and stuff, but we got access to like a market watch game like that, where we got the $100,000. And but this one was, instead of it being over a couple weeks, it was over like the whole semester. And we meet regularly, and we had people from Vanguard and SunTrust and all kinds of banks come in and talk to us about investing. But um, so I've done a couple of those games pretty similarly, and I treat it not like my real portfolio, because it's play money, which I'm glad I don't invest that way, because I don't think I'd make it. But yeah, back to that original high school game. I don't think we ended up doing great. You know, I can't imagine it going very well, but it was a good intro into how stocks move, and just headlines, and just the craziness of the markets. And when you have play money, just being a little adventurous with it.
Yeah, I have a story about where I did the same thing. So I went to the University of Florida. I was a finance major. I'm obviously like 9 years older than you. So if you kind of rewind that back, That was not a great time for the stock market, but like we did a simulation in our equities class, and I want to say it was like 2010, maybe 2011. I'm not sure. I don't really remember, but they were like, "Oh, pick your portfolio or whatever." And I did, and for extra credit, and I did,
Right.
and totally forgot about it.
Oh,
Complete, like 100% forgot about it. Like the winner will get extra credit. I was like, literally. So, and it was semester long. So we're like 3 months in or whatever, and the professor's like, "All right," or the TA, it's like, "All right, let's look at how we're doing in our simulation." I was like, I said out loud, like, "Oh God, I lost," like because I forgot about it, and my portfolio was down like a little bit less than 1%, and
uh-huh.
I won
Wow.
because the market was super down, and everyone else was trading a lot, and I forgot about
Right.
it, and I won.
Right. That's exactly how games like that go.
Which
You do
I
the
learned
least,
from
you
that
forget
too,
about it.
right?
Right?
Yeah, don't look, forget. That's the way to go.
Yeah,
So I got extra
it's a
credit.
good it's a good message for sure. And I wish I could be a little bit more disciplined about it nowadays, but you know,
Well, now you can't.
doing
Now you're
doing
tweeting
better.
about it every day.
Oh right. No, that I just tweet stuff that I need to hear. I don't tweet stuff for other people. I just say the stuff that I need to be told, you know?
I know you have great tweets. They're great reminders about things like that. Um,
Thank you.
so, um, okay, so we talked about how you got into stocks. At what point did you get so interested in dividend stocks?
Yeah, I mean, that's a good question. So I think like with that long term approach, um, I do hold a lot of index funds, and those aren't always great to talk about. I mean, pretty basic, pretty broad. Everyone should own some, in my opinion. But then I started looking at individual stocks, individual companies, trying to get some outperformance in my portfolio because there are plenty of dividend paying stocks that outperform the S&P 500, outperform index funds, things like that. Um, so what I mostly try to focus on is dividend growth stocks. So kind of touching back on the companies that have a history of payouts. So the goal there is to find companies that have a history of raising their dividends faster than the pace of inflation. So your money, the dividend payouts are growing faster than the cash that you would be holding is is losing value due to losing purchasing power due to inflation, which nowadays it's a little that's a sensitive topic. But that's kind of
Anybody?
the goal there. So normally 2% is the rule of thumb, 2.5% rule of thumb. Not going to comment too much on inflation nowadays, but really high.
You got some 7% ones you're not telling us about.
I mean, like Home Depot, their 5 year dividend growth rate is like 20% or something crazy. There's some stocks out there that have short little bursts, but over the long run, um, there's some 10% dividend growth stocks out there where they're simply raising. I think a lot of people on Twitter get confused of what dividend growth stocks are, and they think it's like a growth stock that also pays a
Right,
dividend. But in
right.
reality, it's literally dividend growth. Like the dividend is growing over time, which indicates a healthy business. The business has cash flow and they're expanding, and that usually correlates with a stock price that is increasing as well. So not only are you getting capital gains through the increase of the stock price, but your dividends are growing as well. And so, stocks like Home Depot, I mean, it's up like 200% the past 5 years. They've been raising their dividend, and waste management. There's a whole litany of ones that I like, and there's a ton out there, and some you have to look for. Um, but I really like dividend stocks because, I mean, they tend to be less volatile. So when you look in the long run of long term investing, there's plenty of days where the tech growth stocks get hit really hard and they're down 5 or 6%. And some of your dividend stocks might even be up if you own some real estate, or might be down a lot less. It kind of makes it a lot easier to stomach that volatility. Which on the flip side, they might have some limited upside. They're not ripping 30, 40% in a week. Um, So it's a
Right.
little bit of a trade-off there. But in the long run, that's where you find really stable, really healthy businesses. Um, and I like the idea of, as I get older, my portfolio is paying out. Say hypothetically my portfolio is 500,000 and it's paying me 30,000. I don't know the math. I'm just spitballing here, but it's
Sure.
paying out X amount. I don't have to sell any shares in order to build cash flow for myself. Like
Yeah.
you could have a portfolio of 1 million, but if it's not paying you any dividends, yeah, you've got $1 million. That's cool, but then you're having to sell your assets in order to have cash. Whereas if I can build a portfolio that pays me, one day, like I'm getting quarterly payouts or monthly payouts from these companies that I own, and that's going to provide me cash flow. Now, I might not be able to strictly live off the dividend income. I don't know if that's a goal of mine. I haven't planned that out all the way, but at least as supplemental income or income in retirement, that's where retirees start transitioning to, is just income. So kind of building that up when I'm young allows me to put in less money right now and let it work for a longer period of time, instead of when I'm in my 30s and 40s worrying about putting all of my money in the market. I can put in less money in my 20s and it'll
Mm-hmm.
compound and grow over time. So since I have time on my side, kind of playing that aspect as well. So
Yeah, the only downside that I can see for that, right? I'm a big real estate person, right? I have like a bunch of index funds. Like about 40% of our portfolio is in, basically index funds.
yeah,
Um, but I think of that as real estate, right? Rents aren't really going to go down, right?
right,
The cash flow is probably going to go up because rents are going to go up, and maybe the expenses are not going to go up by as much, right? But with dividend stocks, I recently read Lights Out about GE, and talk about a stalwart. I mean, there was not a more mature business, right?
right,
The only original member of the Dow Jones Industrial Average, right? At the time in 2018.
right,
But of course, we know where that ended. They got removed from the index, right? And they had like some accounting issues, and now we just heard they're splitting up into three different businesses, and the conglomerate
crazy,
business model is over. I don't know. Nobody talks about GE, and it's a blow your mind kind of story, right?
right,
And the first notice that something was going wrong was they cut their dividend,
right,
right? And the part of the reason they had the accounting problems was because they didn't want to cut their dividend,
right,
right? So how do you? I guess if you have an index of dividend growth stocks, that solves that problem.
right. So there are some index funds out there. I know Vanguard has one.
Mm-hmm.
Stock ticker is VIG, Vanguard Dividend Growth, and it's got a bunch of dividend growth stocks in it. It's pretty great. But to your, you know, I didn't want to catch off. I didn't want to take that and run.
Oh no, I was just gonna say, like, if you have a handful of say you pick, you're like, I'm gonna retire on dividends, right? And say you do want to do kind of what you were talking about. You want to live off 30 grand a year. You do the math, you have these dividends, the dividends are gonna pay off 30 grand a year, whatever, and you have a handful of GEs in there. I mean, could that really hurt you? I guess that's the only thing that I've always wondered about dividend stocks is companies don't last forever. Even GE didn't make it, into its
Right,
second hundred through its second 100 years or whatever.
right. Yeah, I mean, obviously you know, there's a lot of unpredictability when owning a single company over such a long period of time. So I think that's where portfolio sizing comes into play, of weighing how much risk you're willing to take in individual names versus risk with an index fund, and your risk with an index fund is a lot lower than an individual name for obvious
Mm-hmm.
reasons.
Yeah.
Um, but I think that's where, unless there's accounting issues and the company's blatantly lying, and then a dividend cut happens, and a dividend cut is a huge red flag. Really easy for me to say right here, right now, but I'd probably just sell my shares right away. Um, I mean, that's usually a pretty, and a pretty big red flag of, okay, dividend cut, something else is going on, or at
Yeah.
least trim my position. Let's see what's going on.
Hmm.
But I think that's where it becomes really important to, it's really great to research new stocks and buy new stocks and buy new investments and things like that. But keep up with the stuff you already own. Like
Hmm.
so many
Yeah.
people like own all these stocks and then okay, what's next? Like what should I add? What should I add? And it's like, no, you got to do your research on the stuff you already own because you need to watch it for the long term. And so that's where a lot of those like ratios come into play. And like when the stock reports earnings and things like that, at least understanding what some of those metrics mean and what the company's saying and what they're reporting. Um, because ideally the company is not lying about the health of their business. So
Hmm.
it normally helps if the company is being truthful and honest. You can kind of keep up and, if you see signs that, okay, they're paying out too much of their net income and, in the form of dividends or there's all kinds of metrics you can look at, but that's where it becomes really important just to keep up with stuff you're already owning as opposed to adding always new stuff to your portfolio. But I mean, yeah, there is single stock risk for sure. I mean, some of the stocks I own are real estate, are REITs.
Hmm.
So you do get, like you said, with rents, things like that. You can get exposure to that through the stock market, even if you don't
Hmm.
own physical real estate. There are stocks that the companies own a lot of real estate, and so
Yep.
you're getting a lot of benefits of that, a lot of cash flow through there. So yeah, to answer your question, definitely some single stock risk. Keep up with the stuff you already own. Kind of set boundaries for yourself on how much risk you're willing to take. Um,
Yeah, I love
and
that. That's such a good point, right? Research what you already own. Brilliant idea. What else do you look at then? Can we talk about some of the metrics? I know you mentioned a dividend payout ratio of 40 to 60%, a history of raising dividends greater than the price of inflation, 2 to 2.5%, right? That's what's
right,
normal, people. We're gonna get back to it. Just hold on. This is not normal inflationary times. Um, what other metrics do you look for?
I mean, a pretty obvious one off the bat is like dividend yield. So, I mean, that's like one of the most talked about ones, but it is an important
Hmm.
metric. It's you find dividend yield by taking the annual dividend and dividing it by the stock price. Um, so I tend to look for stocks in typically they fluctuate between like the 1% and the 3% range. That's typically where you're going to find dividend growth stocks because the stock price is going up as well as the dividend, and they, you know, in between like the 1% and the 3% range indicates that okay, this is a healthy range. The stock or the company is able to pay out this dividend. Um, but when you start getting some higher yields, if I say anything like over 6%, you need to start digging into the metrics of okay, how much cash do they have on hand? Where's their cash coming from? What is the dividend? How much cash they have on hand, and how able are they to pay out the dividend? Which dividend payout ratio comes into play there. But yield is like a really quick metric to look at. Okay, they're at a 2% yield. They've been raising their dividends for 30 years. This seems like just as a quick snapshot, that's usually the kind of analysis I'll do. And then, you know, so quick analysis that I do is like dividend payout ratio, look at the history of their dividends, their growth rate, how long they've been paying out, and then I look at dividend yield. Those are like my three go-tos. And then if those start checking some boxes, then I'll dig in further. I like to learn about the company, how the company makes money, what kind of sector they're in, and then just depending on the company, I go from there. Um, but those would be um, my three main metrics that I look at when analyzing dividend stocks.
Okay. Yeah, that's really helpful. And it is interesting, right? Where you think high dividend yield. I want higher yield.
Right. So with high yield, a lot of times you're sacrificing growth. You're
Yeah.
sacrificing one, stock appreciation, and two, you're sacrificing the company raising the dividend. So there's a lot of underperforming assets. So yeah, you pay out big dividends, but you're not worried about growing your capital as well. So
Right.
I'm certainly focused on growing my capital, growing my dividends, things like that. High yield is more, hey,
Yeah.
here's a really big dividend. It's going to compound on itself. But in the long run, there's a another metric called yield on cost. So it's showing you what your initial or what your basically what your cost basis on that investment is yielding. So like if you bought a bunch of Home Depot at 160 when the market crashed from COVID, and the Home Depot is back to like 380 now.
Hmm.
Your initial investment is yielding a lot higher than the dividend yield now. Like your money is yielding a lot more than its dividend yield. Say Home Depot's dividend yield is 2%. Well, your initial investment might be yielding 6% because the investment has grown and the dividend has grown over time from your
Hmm.
initial cost basis.
Yeah. I sold business acumen training as my full-time job for like 6 years.
Uh huh.
And that's something that you learn about finance is you can't just track one metric or one measure, right?
Right.
Because you could a business could have a really good return on assets or whatever, but maybe be sacrificing in other areas of their business, right? Maybe their return on capital employed or things like that are not as good. So that's why I like that you said that you have to look at multiple things. You have to analyze the stock as a whole. You have to, and remember, it's a business, right? It's sometimes I think we talk about stocks like they're like their own thing, but you're buying a piece of a business, right? Sure, there's this question of is it going to appreciate or whatever, but really at its core, what makes it appreciate should be what the business itself is doing too.
Right. Yeah, that's a great point. It's funny you mentioned that. I actually watched. It came up on my Facebook feed earlier, like a 1 minute little snippet video of Jeff Bezos talking, and he was talking about Amazon back in the early 2000s, how he watched the stock price fall from like 100 down to $6. It fell
Mm-hmm.
from like an astronomical amount, and he didn't get it because like every quarter, all of their internal metrics were growing. Their number of customers were growing, their sales were growing, this was growing, the business was doing great, but the stock wasn't. So he was able just to forget about what the stock was doing and didn't even focus on that because he was so focused on building his business, he didn't care about what the stock did.
Right.
So, I mean, it's a great point. Everyone just looks at stocks, but like, if you own a business, I feel like it'd be really easy to really hyper focus on the business and not care about the stock. But if you don't own a business and you're just buying the stock and you don't care about the business, then you're going to get the two detached. And a lot of times those two don't trade in sync. Like the stock can be doing terrible, but the business could be doing great, or vice versa. The business could be suffering, but the stock could be doing great, and you would have no way of knowing if you didn't pay
Right.
attention to the business.
Right. And that's how you get, I like that word that you used, outperformance, right?
Right. So I mean, there are people who are value investors, so they try
Sure.
to find businesses that are doing better than the stock price would indicate. And so there's other metrics they look at, like PE ratio and all that good stuff.
Hmm.
And so
Hmm.
they try to find businesses that, okay, the stock price is eventually going to catch up to where the business is, and hopefully it will outperform. I'm certainly not a value investor. I understand value investing and I get the merits of it. Um, but I mean, growth investing has outperformed vastly lately or the past
Yep.
10 years. And it's so funny. I work for a cloud slash cybersecurity company. Um, so I'm in the tech world every day. So it's like the most like non-dividend paying stocks. Like there isn't a dividend paying stock. Just that industry as a whole. That's where you find really high growth, high tech names. So I know a ton about cybersecurity. I know a ton about cloud. I know a ton about this, that, and the other. I know all these companies, and I do own plenty of growth stocks as well, or I do own growth stocks as well, merely because I understand them through my line of work, less as a pure investment strategy. But it is kind of ironic that I do, I'm in the cloud every single day, and I look at dividend stocks and I'm like, yeah, that's the route I want to go.
Yeah. Well, I love it. I mean, every time I talk to somebody, I interview somebody for this podcast, it's just becoming so clear. And that's partially why I do this, for listeners to understand different ways to invest, and that personal finance is personal, right? You don't have to do, the Warren Buffett, right? He's the value, like the value guy. That was like his thing, right?
Right.
You don't have to just have, Tesla and a bunch of tech stocks, right? You don't have to just invest in real estate through buying physical real estate. First of all, there's a million ways you can own real estate, but you can, like you mentioned, you can own real estate investment trusts, those REITs, and you can own stock in companies that own a bunch of real estate. And then you don't have to get a call like I just did, like, what do we do with our towels? you know right, I just got
Right.
that call, right, because one of my short-term rental guests is going to check out, right? But you can own REITs that way, and those are dividend stocks, and that's, I forget to think of them that way, so I'm glad you pointed that out as well. So is there anything else you want to add before we wrap up?
I can't think of anything. Cover a lot of bases here this evening. So this has been awesome.
Yeah, thank you so much for coming on. Just to wrap up, managing money is a huge part of adulting, and we're learning every episode different ways to invest the money. Dividend stocks sound like a really cool option. Ross, why don't you tell people how to get in touch with you?
Yeah. So my main channel is on Twitter. It's at Hero Dividend. It'll come up as at Dividend Hero was taken, so I had to do my at Hero Dividend, but everybody knows me as Dividend Hero. So you'll find me on Twitter. And if you listen to this podcast, listening this far, that's awesome. Lauren does a great job with all this. I'm super glad she had me on. Feel free to shoot me a DM. Let me know you heard me on this podcast. If you have any questions or any comments or anything like that. My DMs are always pretty flooded, always pretty busy. But if you let me know that you heard me on Lauren's podcast, I'll be sure to get back to you. There's plenty of people I ignore for obvious reasons. I get ridiculous DMs. But seriously, if you send me a DM, let me know you heard me on this podcast. I will get back to you. And I love meeting people. I talk to people all the time in DMs. That's probably where I spend half my time on Twitter anyways.
Mm-hmm.
So I love getting to know people. So yeah, reach out if you got any questions or if you just want to say hey. That'd be awesome.
Yeah, thanks, Ross. It means a lot. Um, and Ross has a ton of like really helpful guides and things too that he's created. So definitely check those out as well. I am on Twitter at AdultingIsEasy. I'm also on Facebook. I'm the worst at posting on Facebook, but if that's your jam, you can find me there. You can email me too at realadultingiseasy@gmail.com or show support at patreon.com/adultingiseasy. Thanks again for listening, everyone. Hopefully, Ross and I have made adulting a little easier for you.